Welcome freaking back, rich bitches. Or if you're new here, hi, my name is Taylor Price, also known as that Priceless Tay, your favorite financial planner to help you thrive, not just survive. And today's video, we're talking about saving too much money. And saving too much money is the worst financial mistake you can make. And no one's telling you why, but in today's video, I will. So if you think your savings account is keeping you safe, I want you to think again, because it might actually be the thing that's keeping you broke. You might not want to hear this, but saving just isn't enough anymore. And in today's video, I'm breaking down how to tell if you're saving too much and what you should be doing instead to grow your net worth. Saving and investing are not your enemies. They are your teammates. I like to call investing really your best employee. You thought you were just an employee yourself. No, honey, your money is your employee and you are the CEO of your life. Remember that. But the key here is knowing when to pass the ball to savings and when to let the investments, your teammates, your employees take the shot. So let's simplify it. You save for stability and invest for growth. If you mix up these two, you might either be missing out on getting rich opportunities or leaving yourself financially vulnerable when life throws you a curveball, which it does. So let's talk about saving the right amount, because spoiler, saving too much can be just as bad as not saving at all. And here's why. An emergency fund is a non-negotiable. It's your financial life jacket. This is the money that saves you when your car breaks down, your dog has an unexpected vet bill, or you lose your job. And without it, you'd be stuck swiping credit cards or taking out those personal loans, which is most likely the fastest way to fall and spiral into debt. So step number one, build that emergency fund worth of 3 to 12 months of essential expenses. Here's what you're going to hear from other people. You're going to hear 3 to 6 months. Why do I say 3 to 12 months? Because let's say in the scenario that you are a single baddie and you're a single baddie without a boyfriend, girlfriend, whoever you're seeing at the time, whatever. You don't have a partner that you also can financially depend on in the case that you get let off or something major happens where you might need some support in your life. So that's number one. Number two, let's say you work in this crazy industry that the job market is so small or super saturated. And let's say you get let go today or tomorrow, you trying to find that replacement job is going to take you a pretty long time just because the industry that you're in, which is another reason why to build up really past that 6 month and go towards that 9 or 12 month. Now, if you're in the predicament of you are able to financially depend on somebody else if shit hits the fan, or you pretty much can get a job pretty easily with what you do, then that's where kind of the 3 to 6 months generalizations come in. But okay, so here's the key. Once you've got that thing fully funded, you don't need to keep stacking cash in that savings account anymore. By the way, put it in a high yield savings account too. Once your emergency fund is fully funded, saving more money in a traditional savings account isn't just unnecessary, it's holding you back. Why, Taylor? All right, it's because most savings accounts earn an embarrassingly low interest rate, like 0.01% to 0.5% a year. Meanwhile, inflation is hovering around 3 to 5%, which means the money you're saving is actually losing its buying power every single year. And you know exactly what I'm talking about when you see that the price of eggs are like $6 to $12, depending on where you're buying them from. Basically, you're letting your money shrink instead of grow. Let's say you've already got $10,000 sitting in your emergency fund. Awesome, amazing, go you. You're covered for those oh shit moments, right? But if you keep adding, say, $500 a month to that account, after 5 years, you'll have about $40,000. Go you. Yeah, amazing. Sounds great, right? No. Don't think too fast here. Listen up. All right? Thanks to inflation, that $40,000 might only buy you $35,000 what could be buying today. So you're basically losing $5,000 off the bat of value without even realizing it. So what do you do with your extra money after your emergency fund is set? That is where investing comes in. This is where getting rich is a decision, not a freaking dream. All right. So instead of letting your money collect dust in a savings account, you can put that shit to work and make it your best employee. So for example, if you invest that $500 into a low cost index fund, earning an average of 8% annually, after 5 years, you'd have over $36,000. That's $6,000 more than just saving. And with inflation factored in, your money is still going to grow and is growing in value. Savings accounts are amazing for emergencies, but once your safety net is in place, you gotta shift your mindset into thinking rich and shifting those gears. Saving more than you need in cash is actually slowing down your financial growth. So instead, invest that extra cash to make your future self very proud and even happier when you made the decision to subscribe down below and changing your life forever. All right, I'm on another mood today, guys, with this. So let's make this super clear. Saving and investing isn't a one-size-fits-all solution. The why behind your money also is going to decide the where. So if you ever wondered, should I save this or invest it? I got a step-by-step guide to help you figure it out right now. Step number 1, understand the purpose of your money. First things first, you're going to ask yourself, what is this money for? Because at the end of the day, guys, money isn't the root of all evil. The desire for getting this crazy amount of money is the root of all evil. If you have a purpose for your money, that's where the good comes into life. This is the ultimate question because it determines whether you save or you invest. And if your purpose, let's say, if you need it in the next 1 to 3 years, save it. If you won't need it for at least 3 to 5 years or longer, invest it. Savings is going to give you that stability for short-term goals, while investing grows your money over time for longer-term goals. Step number 2, when to save and actually where to save. Short-term goals, 1 to 3 years. If you've already got a goal that's coming up in the next few years, like saving for a vacation or a wedding, or even a down payment on a house, you'll want to keep that money safe and accessible. I'm curious, by the way, too. Leave a comment down below on some of your money goals. Make it loud and proud. Let's keep an accountability group forming, some sort of community, certified rich bitches, you know what I mean. Leave a comment down below. I read almost every single comment, so let's see. Let's talk. Let's get the conversation going and throw that shit into reality. When we're talking about these short-term goals, this means saving it, not investing it. And you might be asking yourself why. Well, I'm going to tell you. And that's because the stock market is unpredictable in the short term, and you don't want to risk losing your hard-earned money right before you need it. So let's say you're saving $10,000 for a house down payment and you need the money in 2 years. Well, if you invest that money and the market drops, you could end up with only $8,000 when it's time to buy your house. But if you keep it in a high yield savings account that's earning 3-4% interest right now, it'll be safe and it'll earn you a little extra while it just sits there. The goal for you and the goal for me at this point in my life is to make my money work as freaking hard or harder as I do or than I do. So now you know you need to save, but where should you actually put that money? It's not going to be under your mattress and definitely not in a checking account. I've hinted at this before. Here's some of your best options. Number 1 is that high yield savings account. Perfect for short-term goals because it's keeping your money safe while earning a higher interest rate than those regular schmegular savings accounts. Your money is accessible at any time, but it's also working a little harder for you. Probably not as hard as you, but a little bit harder for you. A high yield savings account works just like a regular savings account, but way better. If you want some account recs to get started, check the link in the description. for my top picks. Number 2 is going to be money market accounts. So another option with slightly higher interest rates than traditional savings, but usually requires a higher balance. Number 3, CDs, yeah, they still exist in the finance world. They're called certificates of deposit. And if you're certain you won't need that money until a specific date, a CD could work for you. It locks your money in for a set period of time, like 6 months or a year, and then earns even more interest than a high yield savings account. But I'm going to throw that red flag out there for you. You've caught the red flag, right? Okay, you've caught it. Yeah, you cannot access that money. It's locked the freak up. So this is like really only use it when you're like, I know I don't need this money. I'm not going to touch this money. It's locked up. It's got handcuffs on it. That's the only red flag for what I would consider with CDs. All right, now step number 3, when to invest and where to invest. All right, so long-term goals, 3+ years. Now, if your goal is further out, like retirement, buying a home in 5 years or so, or building long-term wealth, getting rich over time, getting rich slow, this is where investing comes into play. Why? Because investing lets your money grow at a much faster rate than saving. Over time, the stock market averages 8 to 10% per year compared to the minimal 0.5% yield on earnings in a savings account. And yeah, I gave that even a higher amount than the traditional 0.01% just to like give a fair shot in this comparison. It's literally the difference between your money crawling versus sprinting towards your goal. Let's say you're saving for a dream home in 8 years. If you invest $500 a month in a diversified index fund earning 8% annually, you'd have around $62,000 by the time you're ready to buy. Compare that to keeping just $500 a month in a savings account where you would only have about $49,000. That's a $13,000 difference, and that's the power of investing. And I would ask you right now, like, what would you do with that extra $13,000? Write it down below. Let's keep that conversation going. So now I really need you to listen up because this is one of my favorite parts, and that is where to invest for your long-term goals. So say you've decided to invest. Amazing. You're in the right freaking place. I'm so proud of you. But where should you actually put that money? So here's a few beginner-friendly options for you. Number 1, your 401k or your employer-sponsored retirement plan. If your employer offers a 401k, start here, especially if they match contributions. It's free money in your freaking pocket and you don't want to miss it. Number 2, a Roth IRA or traditional IRA. This is going to be perfect for retirement savings with tax advantages. And number 3, brokerage accounts. These are great for non-retirement goals like saving for a future home or even just growing your wealth. Look into low-cost index funds or ETFs for simple, diversified growth. And if you still have questions, check the link in the description for some of my top picks for brokerage accounts, and you can read up on more information on all of those accounts that I just listed or even watch some videos that I have. Step number 4, combine saving and investing for maximum impact. The truth is, saving and investing go hand in hand. You save for your short-term goals and emergencies. You invest for your long-term dreams and aspirations. This is you making that decision to get rich, not just a dream. You're making those dreams come to a reality through investing with that core portfolio. So it's about a balance. One that gives you security, the other one gives you growth. The magic happens when you do both the right way. So let's say you got $1,000 a month to allocate. You might put $500 towards short-term savings in a high-yield savings account, and the other $500 toward long-term investing in your core portfolio of index funds. Bada bing, bada boom. You're building security and getting rich at the same time and becoming that certified rich bitch. And y'all, let's get real for a second. I've been literally having one-on-one chats with you over the past few weeks, the past few months, getting to learn about you on these calls that I'm putting on my Instagram. So if you don't follow me on Instagram, make sure to check there because I love hopping on a call, getting to know you, getting a little chat and here and there. And so many of you say investing feels scary. I mean, putting your hard-earned money into something that doesn't come with guarantees, right? I want to let you know, here's the truth. When there's no risk, there's probably minimal to no reward. And if you don't start investing, your future self is going to be the one that's paying the price. So let's break down how to overcome those fears and why taking calculated risk is going to be worth it and how starting to invest in a way that feels less intimidating and way more empowering. I like to say, let money liberate you instead of intimidate you. So some common thoughts that I be hearing from you guys. What if I lose it all? What if the market crashes? What if I mess at the top? What if I mess up? Trust me, I get it that fear is rooted in something called a money script, a belief we've picked up about money often without realizing it. Some examples of money scripts that are holding you back right now as you're watching this video. Maybe you were taught growing up that money is something that you have to hold on to tightly, so investing feels like giving up a lot of control. Maybe some fear of risk. Maybe you've heard horror stories about market crashes and believe investing is only for rich people who can actually afford to lose the money. The truth about that, you don't have to be rich, an expert, or even fearless to start investing. You just have to start small. Investing isn't about betting on a random stock and crossing your fingers. It's taking calculated risks to grow your money over time. And the key here is understanding that the biggest risk actually is doing nothing at all. I love examples, so let's throw one up. And let's say you keep $1,000 in a savings account for 30 years with an average interest rate of 0.5%. Again, I'm giving it the benefit of the doubt here, giving it a fair shot. You'll only earn about $160 in interest. Now invest that same $1,000 in an index fund earning 8% annually. You'll have $10,000 plus by the end of those 30 years. That is the power of taking calculated risks, guys. And I want to say one of the biggest mistakes that people make when it comes to investing is focusing on the very short term. The stock market might go up and down today, this week, or even this year, but over the long term, it almost always trends upward. And this is why, by the way, it's like, okay, if you invest at the top of the market, okay, that kind of feels like shit right now, especially if it goes down a little bit. But if you're in it for the long run, it has continuously proven to go up and up over the decades. Historically, the market has averaged about 7 to 10% in annual returns, even with those crashes that we've seen crazily on the news and recessions along the way. So instead of panicking when the market dips, think of it as a discount sale on your future wealth and getting rich. So let's say you invest $100 a month for 40 years in a diversified fund that earns at 8%. By the time you're ready to retire, you're going to have over $500,000. Can you imagine that? I mean, God, like what the heck? What the heck? That's not magic. It's just time and consistency doing its freaking damn thing. Make that shit your best friend. If you panic every time the market dips and pull your money out, you're going to lose your long-term growth potential. You don't have to dive headfirst into investing with thousands of dollars. In fact, starting small is often the smartest freaking move. Platforms like Acorns or beginner-friendly investing apps let you invest with as little as $5. The trick is consistency. Even small amounts invested regularly can add up to something huge over time. And if you don't believe me on this, there's literally a study on this because I'm here freaking throwing up all these facts. You earn more majority of the time through dollar cost averaging and getting that average over a certain period of time. You might be at a high, you might be at a low, instead of just investing at one point in time in the market where you might have invested at the high, you never invested again, you didn't average down, and now you actually lost money in comparison than if you literally just invested a little bit here, a little bit there, a little bit there, a little bit there throughout that consistent period using the same amount of principal or whatever contribution amount that you decided to set forth in that example. Here's a few quick tips, all right? Educate yourself, learn the basics of investing. Start with index funds, ETFs, or even your 401k. You don't need to necessarily know every single thing, just enough to make those informed decisions. 2, start with an amount that you feel comfortable losing, whether it's $5, $50, $500. Pick an amount that won't keep you up at night and panicking, all right? Think of this as your learning experience. Think of this as your investment in this whole educational process. Number 3, automate those contributions. Set it and forget it. Automatic investing takes this emotion out of the equation and keeps you consistent. I like to use this analogy of I'm like an all right bowler, and I don't know if you bowl either, but if you have those gutters up, all right, those gutters, when you bowl, you're at least going to hit one pin. That's the same thing of you thinking about automatically contributing to your investment account. It's happening. You're putting in that $5 a month or whatever that amount may be. You could be rounding up, but it's working for you and it's happening. The discipline, it's on the automator, the automation tool that you're using. So if you're feeling unsure, think about it this way. Every dollar you invest today is a gift to your future self. Investing isn't about getting rich overnight. It's about building the life you want one step at a time. It's about freedom, opportunity, the ability to say yes to things you truly care about. So at this point in the video, what's stopping you? The biggest risk isn't investing. It's letting fear hold you back. Ask yourself right now, and I want you to pause this video if you really need to think about it. What's the first small step you can take today to start getting rich for your future self? And this, one of the most important points of this video, objections that is going to be had right now. People lose a lot of money versus those who make a lot of money in the stock market. Let's clear up one of the biggest misconceptions that people have about investing. Most people don't lose money in the stock market because the market is risky. They lose money because of their habits. Yup, it's not about the market. It's us. It's you. It's me. It's us. So let's break down some shocking stats about who's winning versus losing in the market and the habits that separate the two. Here's the harsh truth. About 90% of retail investors, aka people like you and me, lose money in the stock market. But it's not because investing is a scam or it's rigged. It's because of how they invest. It could be because of emotional decisions. And according to research from Dalbar, the average stock market investor only earns 3.6% per year, far below the market average of 8 to 12% per year. Why? Because they panic sell during market downturns and chase hot stocks during bull markets. For example, 2020, a pandemic dip scared many people and many investors into selling out, only for the market to bounce back and hit record highs. Those who stayed in the market made huge gains, while those who sold locked in their losses. Trying to time the market is also a reason why people lose money. Studies show that timing the market perfectly is nearly impossible. A JP Morgan study found that missing just 10 best trading days over a 20-year period could cut your total returns in half. Example here, if you invested $10,000 in the S&P 500 from 2001 to 2020, but missed those 10 best trading days, your return would drop from $32,421 to just $16,180. And number 3, over trading. Frequent traders tend to underperform the market by 6% annually for a lot of reasons, fees being one of them, emotional decisions being another, and poor timing. So I want to talk about the flip side now because that was kind of a drag and I don't want to scare you out of investing. This is the good stuff. This is the good goods. The people who do make money in the stock market don't necessarily have insider tips. They're not Martha Stewart or superhuman skills. They have better habits. Let's look at some of the stats here. Number 1, they stay invested long term. Over any 20-year period in history, the stock market has delivered positive returns 100% of the time. That's right. If you stayed invested for 2 decades, you never lost money. Why does this work though? Time in the market beats timing. the market. Compound interest needs to work its magic, and staying invested through market ups and downs ensure you capture long-term growth to getting rich. Another example, if you invested $10,000 in the S&P 500 in 1980 and did absolutely nothing, it would be worth over $1.2 million today. And that's just by letting it sit tight. Another thing about people who actually make money in the stock market, they diversify their portfolio. Diversifying their portfolio reduces their risk of major losses by spreading investments across different assets, stocks, bonds, ETFs. And why it works? Diversification makes sure that if one investment performs poorly, others can help balance out the losses. The old saying, don't put your eggs in one basket, is literally how the pros win. Imagine you put all of your money in one stock like Blockbuster in 2000. Wow. But if you spread your money across an S&P 500 index fund, you would be holding companies like Apple, Amazon, Tesla, which have soared over the last 20 years. And rich folks, they also automate their investments. People who automate their investments are 95% more likely to stick to their plan. Automation takes out this emotional part of investing. Whether the market is up or it's down, you're consistently contributing, which allows you to take advantage of dollar cost averaging, DCAing your way to getting rich. Let's say you invest $200 a month automatically. If the market's down, you're buying more shares at a discount. If the market's up, you're still buying, but at higher prices. Over time, it balances out and smooths your returns. And also, rich people, they don't check their portfolios every single hour, every single minute. Research from Betterment found that investors who check their portfolios frequently are more likely to make impulsive emotional decisions and underperform as a result. Successful investors know that the stock market is a long-term game. Checking it every single hour, every single day makes you hyper-focused on short-term losses, which can tempt you to sell at the worst point possible. Think of it like planting a tree. You don't dig it up every day to check the roots, right? You just let it grow. Same thing with investing. The stats do not lie. People who make money in the market aren't lucky. They're patient, they're consistent, and focused on the big picture. They invest regularly, diversify, and stay invested through the ups and downs. So the question is, are your habits helping you get rich or holding you back? If this video helped you feel more confident about managing your money, making that freaking money, let me know by dropping a comment below. And like I said, what's your next money goal? Saving, investing, paying off debt? Don't forget to like, subscribe, and share this video with somebody who could use some motivation today. And I will see you baddies in the next one. Peace.